Welcome to the Leaders Insights podcast. Today's episode, IPO readiness, what it really takes. Most CFOs think they're 18 months from an IPO. How many actually are?
Almost none. I've sat in rooms where the CEO says, we'll go public next year, and I'm looking at a finance team of 9 people who close the books in 25 days. Public companies close in 5. You're not 18 months away, you're a rebuild away.
That sounds like you're moving the goalposts. What does ready actually mean mechanically?
It means you can produce audited numbers that survive strangers picking at them on a schedule you don't control. The durable principle here is that public markets don't care about your story. They care about whether your controls hold under pressure. An IPO, an initial public offering, selling shares to the public for the first time, is just the moment they start testing that.
Give me the things CFOs consistently underestimate.
The internal controls work. Sarbanes-Oxley, the U.S. law that makes management personally certify that your financial controls actually work, is the graveyard. Everyone budgets for the bankers and the lawyers. Nobody budgets 18 months and a couple of $1 million to document how a single invoice moves through the company without a human quietly overriding it.
A couple of million just to prove your controls exist?
Easily. And here's the part that stings. The day you announce your revenue recognition, the rules for when you're allowed to book a sale as revenue gets relitigated by auditors who assume you did it wrong. WeWork learned that publicly in 2019. Their community-adjusted EBITDA got laughed out of the market. EBITDA is earnings before interest, taxes, depreciation, and amortization, roughly profit before the boring stuff. They'd invented a version that stripped out real costs.
But that was a governance clown show. A serious company doesn't do that.
Serious companies do subtler versions constantly. They have 3 sales teams booking deals 3 different ways. They have a founder who signs off on discounts by text message. None of that survives a public audit. The step back is this. IPO readiness isn't a finance project. It's an operating discipline project. The best operators figured out years ago that you build public company plumbing while you're still private and nobody's watching.
How do you know if you can actually withstand the scrutiny? Give me a test.
Run a mock earnings call. Get your team to forecast next quarter, publicly commit to a number, then miss it and explain why. If your forecasting is off by more than 3 or 4%, you're not ready. Public markets will forgive a lot, but they will destroy you for guiding to a number and whiffing it. That's the reflexive punishment.
What's a real number on how often companies get that wrong?
Look at the 2021 cohort. The SPAC wave, special purpose acquisition companies, essentially shell companies that take you public through a back door. A huge share of them missed their own first-year projections badly, and a chunk traded below where they started within a year. That's what happens when you go public before the forecasting muscle exists.
So is the lesson just wait longer?
No, the lesson is start the discipline earlier and separate it from the timeline. I tell CFOs to run the company as if quarterly reporting already exists 2 years before any offering. Close fast, forecast honestly, document your controls, kill the founder's text message approvals. Then the IPO is a financing event, not a personality transplant.
Name a company that got this right.
Datadog, the monitoring software firm, went public in 2019 quietly and boringly. Predictable numbers, clean guidance, no drama. Boring is the compliment. They'd built the machinery early, so the market just had to price it. Compare that to the ones who treat the IPO as the moment to suddenly become adults.
One thing a CFO should do Monday morning?
Time your close. If it takes more than 5 business days to produce numbers you'd stake your reputation on, that's your entire problem in one metric. Everything else, the bankers, the roadshow, the story, is downstream of whether you can count fast and count right.
Count fast, count right. That's the whole game. That's it. The CFO decision tools are live at mba-training.com.